Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Li & Man Chemical Company Limited annual report. Li & Man Chemical Company Limited offers a diverse range of chemical products and services. The company's chemical segment provides various products such as caustic soda, chloromethane products, fluorochemical products, hydrogen peroxide, liquefied chlorine, polymers, polytetrafluoroethylene, styrene acrylic latex surface sizing agent, lithium-ion battery additives, and other chemicals. In addition to its chemical offerings, the company also provides a range of specialty chemicals including thionyl chloride, liquid polyaluminium chloride, solid polyaluminium chloride, hexafluoropropylene, fuselicic acid, anhydrous hydrogen fluoride, hydrofluoric acid, chloroform, dichloromethane, methyl chloride, and chlorine. The company also offers sodium hypochlorite and hydroxide. The company's property segment is involved in the development, sale, and rental of properties, as well as provision of property services. Furthermore, Li & Man Chemical Company Limited engages in research and product development to stay ahead in the industry. The significant increase in Li & Man Chemical Company Limited's stock price over the past year can be attributed to several positive news events that have boosted investor confidence and driven up demand for the company's shares. One of the key factors contributing to the rise in L&M Chemical's stock price is its impressive financial performance. The company's midterm results for 2025 showed a 36% increase in profit, driven by reduced energy and raw material costs, which led to a significant improvement in its gross profit margin. This was followed by robust annual results for 2025, with a 15.8% surge in profit, primarily due to lower costs for raw materials and energy. The company's strategic expansion plans have also been a major driver of its stock price increase. The announcement of new production lines for VC and fluoropolymer, as well as the entry into Vietnam, are expected to drive future growth and diversify revenue streams. This has not only boosted investor confidence, but also increased demand for the company's shares. The recent stock surge following the positive annual results is a testament to the company's strong financial performance and strategic plans. With a proposed final dividend of HK 14 cents per share and a total dividend payout of HK 33.5 cents per share, investors are likely to continue to be attracted to the company's shares. Overall, L&M Chemical's impressive financial performance and strategic expansion plans have been the primary drivers of its stock price increase over the past year. Li & Man Chemical Company Limited maintains a market capitalization of $5 billion, broadly in line with the industry peer group. Li & Man Chemical Company Limited trades at a lower price-to-earnings ratio of 9 times and a lower price-to-book ratio of 0.78 times relative within the industry. This makes the stock appear attractively priced. However, the broader industry is also trading at low valuation levels, suggesting sector-wide pessimism rather than the company-specific undervaluation. Further evaluation is required to identify if the company worthy of investment, or could it be an extended period of low valuation or a value trap. The balance sheet appears very conservative, with liabilities representing only 18% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 5.66%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline in a company can be attributed to various factors. On one hand, revenue decline is often driven by external pressures such as supply-side issues and insufficient demand-side support. For instance, notable declines in chemical product prices were observed due to these factors. On the other hand, revenue growth can be attributed to internal factors such as cost reduction and increased sales. In the case of the company, modest price declines, significant drop in energy costs, and decline in raw material prices contributed to revenue growth in the chemical operations segment. Additionally, high sales of residential units at RIVRDALE led to an increase in property operations revenue. The chemical segment experienced a 4.3% decrease in revenue due to unspecified reasons, while the property segment saw significant declines without specific details provided. However, certain products such as caustic soda and lithium-ion battery additives showed remarkable growth, with increases of 4.1% and 1,411.4%, respectively. These findings highlight the importance of understanding the underlying drivers of revenue growth or decline to inform business decisions. Net income for the company saw a significant increase, rising by 15.8% to HK$558 million, and further increasing by HK$131 million to HK$1,295 million. This substantial growth in net income is a positive indicator of the company's financial health. The profit margins also experienced an upward trend. The gross profit margin increased by 5 percentage points to 34.5%, while the net profit margin rose by 2.7 percentage points to 14.9%. These improvements suggest that the company has become more efficient in its operations and better at converting sales into profits. The company's debt level and interest expenses have undergone significant changes in recent years. Initially, the bank borrowings saw a substantial decrease from HK$587,937 to HK$0 on page 3. However, this trend was short-lived, as it increased by 71% to HK$104,011 on page 4. Despite the fluctuations in bank borrowings, lease liabilities have decreased significantly, with a notable drop of -90% from HK$1,378 to HK$126,004 on page 11. This reduction is consistent across different pages, indicating a deliberate effort to minimize lease obligations. Interest expenses and finance costs have also seen a decrease. On page 11, finance costs interest on bank borrowings decreased by 20.8%, while on page 18, interest expenses dropped from HK$22 million to HK$17 million. Furthermore, finance costs were reduced by HK$5 million compared to the previous year. The net debt has also decreased, with a reduction of HK$7 million from HK$358 million to HK$351 million on page 19. Overall, these changes suggest that the company is actively managing its debt and interest expenses, aiming for a more stable financial position. The performance of various segments and regions within the company has shown mixed results. On the positive side, the chemical segment has demonstrated improvement, with revenue from external customers increasing by HK$171,746 from HK$3,922,260 to HK$3,751,514 in 2025. Additionally, segment results have also improved, rising from HK$591,182 in 2024 to HK$725,368 in 2025. In contrast, the property segment has struggled, with revenue from external customers plummeting by HK$25,319 from HK$28,573 in 2024 to HK$3,254 in 2025. Furthermore, segment results have worsened, resulting in a loss of HK$1,205 in 2025 compared to a loss of HK$101 in 2024. These contrasting performances highlight the need for targeted strategies to address the challenges faced by each segment and region. Management's outlook on company strategy. The management of our company has provided a clear indication of its approach towards maintaining financial stability. One key aspect of this strategy is the assurance that sufficient cash reserves will be maintained to meet all financial commitments. This proactive measure ensures that the company remains financially secure and able to fulfill its obligations. In addition, management is actively working on optimizing financing costs by carefully balancing borrowings in different currencies. This approach enables the company to minimize its exposure to currency fluctuations and reduce its overall borrowing expenses. By taking a strategic and proactive stance on financial management, the company is well positioned for long-term success. The company's financial activities have been transparently disclosed. One notable aspect is the payment of dividends to its shareholders, as confirmed on page 12. This indicates that the company values its investors and has a history of rewarding them with dividend payments. On the other hand, the company has not engaged in share buybacks, according to information found on pages 1 and 16. This suggests that the company is prioritizing other financial strategies over repurchasing its own shares. Concerns about inventory buildup are mounting due to a significant increase in raw materials and consumables inventory. According to recent data, this type of inventory has risen by 8%. Furthermore, finished goods inventory has also seen an alarming surge of 18% over the same period. This accumulation of stock is compounded by slower inventory movement, with turnover rates decreasing to 87 days. These statistics collectively indicate a potential for supply chain disruption and highlight the need for companies to reassess their inventory management strategies. That concludes the financial summary for Lye & Man Chemical Company Limited. Feel free to comment below, and I will be happy to answer them when possible.